right, good afternoon and welcome back everyone to our educational session this afternoon. And I have a very special guest, Michael Khouw, to discuss trading oil futures. And the reason we're here to discuss this product specifically is because trading oil, and Mike, please feel free to chime in here in any second, because I personally find trading oil has historically been a fairly confusing complex of different products that are available, whether you're trading futures or ETFs. So Michael, your background in oil futures, I think is going to be really useful in giving our audience a better understanding as to the different products that you can trade, the introduction of the small futures, as well as some color around the fundamentals, if you will, of the oil market. So first of all, Michael, thank you so much for joining me.
Yeah, it's my pleasure. I'm happy to be here. And with any luck, I'm going to figure out why I have that very strange icon replacing my face, because my camera's on, but it's not showing me. So I'll continue to work on that.
While you do that, and I know, Michael, you are on fast money here in about less than 45 minutes. So I appreciate you taking the time out here this afternoon. I do want to make sure that we get to, there you go. I do want to make sure that we get some time to make sure we discuss these things with you. But before we do, what we're going to talk about here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And Mike, what we're going to do is we're going to talk fairly briefly about just the introduction of trading oil, because like I said, it's a bit of a minefield in terms of just the complexity around trading oil, what type of oil you're trading, what type of products you're trading, what you kind of look at in terms of understanding, the directional view of oil. Then we'll talk a little bit about the crude oil products that an investor can trade, whether we're talking about futures or ETFs. And then I want to pick your brains a little bit about, oil fundamentals. This is really where I think you have a lot to lend in terms of your expertise in this and your background in trading oil. And then I'll talk a little bit about the technical side of things before we go into some live trading examples and open this up for Q&A here at the very end. Now, before we jump into this, Michael, I just want to give you, many of you know Michael, him and I are on Options Action every single Friday afternoon. But for those of you that may not know Michael, Mike, do you mind just giving just a brief background on your trading history, specifically with respect to trading oil?
Sure. So I began in the derivatives trading business in the 1990s. I worked for a prop trading firm, a proprietary trading firm that also made markets and options at first on the 4 listed U.S. equity options exchanges at that time, which were the Philadelphia Stock Exchange, the American Stock Exchange, the Chicago Board Options Exchange, and the Pacific Exchange. I had seats on both the Philadelphia Stock Exchange and the American Stock Exchange. I focused principally on trading oil equities in the 1990s. I also stood in the oil service index options pit on the Philadelphia Stock Exchange. So before there were ETFs or that they really gained much traction, they had sector indexes, and Philadelphia was one of the places that those traded. Subsequent to that, so I was also trading names like Halliburton, Schlumberger, and so on. After doing that for several years, that company was sold to Knight Capital Markets. I moved to another company called Bluefin Trading, which still exists. Largely, I would call it a spin out of Susquehanna because it's mostly former Susquehanna traders. I was an exception to that. And they wanted to start an energy trading business. And so one of my colleagues, Sean Gorman, and I started their options business on the New York Mercantile Exchange. So we both got seats on the New York Mercantile Exchange. Sean Gorman traded oil crude futures. That's the WTI NYMEX oil contract, which will be relevant when we just talk about the different products that are available and the options on those. I was also trading those. We traded some product options as well. So that's the options on gasoline and heating oil, and also natural gas. And ultimately, I was trading mostly natural gas options, but the natural gas options and crude options both trade in the same pit. So when you were looking at the New York Mercantile Exchange, all the people yelling and screaming in the colorful jackets, one of the big rings was the crude options ring. The other big ring was the natural gas options ring. And the options ring stood right between those two. The idea being that the options traders could then see what was happening in the respective big futures contracts pits. And then all of the mini contracts traded on risers outside of those rings. So, that was when I was actually in the pits yelling and screaming. Fortunately, still have a little bit of a voice left because many people who've done that for a long time do not. And we traded and made markets on crude futures, options, and minis, and natural gas futures, options, and minis as well.
Well, I mean, first of all, I think we're very lucky to have you here to discuss trading oil futures, given your background in this. But I think what the introduction that you just gave speaks a little bit to just the complexity, if you will, of the energy markets, if you will. When we talk about energy, there are so many different energy products. Which one are you really trading? So I do want to differentiate, some of the things you talked about. You talked about WTI, you talked about natural gas. From your perspective, when we talk about trading crude, what do you actually, what contract are you referring to when we talk about trading crude oil?
So if you had asked me back then, WTI NYMEX crude oil, the big contract, was essentially the benchmark crude oil contract. So one of the important things to remember when you are trading physical commodities is that there are, of course, different grades of those commodities. There are different delivery points. And so those dynamics all play into those markets. And when we tune into the news and people say, oh, the price of crude rose or the price of crude fell, we tend to think of it sort of as this monolithic thing, like there's a single price for crude. That's not the case, of course. When you think about the price of crude, what grade of crude, what delivery point, and when, all of those things play significantly into the specific price of oil in that market. So the NYMEX WTI crude oil futures contract, which used to be the benchmark contract, settles at Cushing, Oklahoma. And Cushing, Oklahoma was chosen as the delivery point because in North America, logistically moving oil around, that is a hub for both rail and pipeline. And so that has been the default sort of contract that we thought about in North America as the benchmark for crude oil. Nowadays, and the grade is a sweet grade, which means it's low in sulfur content. Brent crude, I think, is probably more the global standard and benchmark for crude oil now. So if you're looking at the WTI contract, ticker will always begin usually CL. The Brent contracts typically are CO. That's a slightly higher sulfur grade usually, but I think that's probably the benchmark when we think about oil now. And one of the reasons also is just because Cushing, Oklahoma, and some misunderstanding about how crude trades has created some very strange dynamics. There are people on this webinar right now who probably remember that in the early days of the pandemic, the front month WTI crude oil futures contract traded negative for the first time ever. I actually did a video about that, explaining why that was. And we're going to talk about some of the fundamentals that play into how things like this happen. But yeah, I think we probably are going to say Brent nowadays. And I think that's probably how OPEC thinks about it as well. And OPEC's in the news a lot because they're talking about curbing production slightly and trying to support prices.
Right. So it's very important just to understand that whenever we talk about trading oil, right, we have to specify exactly what grade of oil we're referring to. And usually when we refer to U.S. oil, we're usually referring to either WTI here or Brent. And Mike, what we're going to do is we're going to dive a little bit into, as you mentioned, OPEC. We're also going to dive into a little bit about EIA reports with respect to understanding supply and demand. That's really where I think I want to pick your brain a little bit and give people who are here on this webinar a little bit more color behind how you analyze those reports and get a sense for supply and demand. And then, like I said, I'll also bring in some of my technical factors into where I currently see oil at the very moment. But let's talk a little bit about the products that exist out there, right? So, you talked about traditional futures, which is what you may have traded on the NYMEX, or when you refer to WTI contracts on the NYMEX. There's also ETFs that we now can trade, and this is really some of the trades that you and I on Options Action talk about when we talk about trading oil or a directional view on oil. We typically use one of these ETFs to leverage them, but today we're also here to introduce the small futures. So let me first talk a little bit about the traditional futures, right? This is something, I think most investors, I'll tell you, when I traded futures, I was an E-mini day trader, if you will. And I remember the one time I decided to just try out trading some crude futures. I really got my ass handed to me, if you will, because I just didn't understand the dynamics of it. But they're huge contracts. Each contract is 1,000 barrels, $10 per tick. So a single penny move in oil prices translated to a $10 move in the contract. And one of the things that really confused me about oil futures at the time was the fact that each month was a different expiration date. And it almost seemed like it was somewhat random as far as which dates they picked. But something you mentioned to me yesterday, physical delivery. This is really, some of the pain points that I would say a lot of retail investors have with trading traditional futures with respect to oil.
Yeah, that's definitely true. So I think it's not just retail investors that struggle with it. One of the big reasons that the WTI contract traded into negative territory last year was because of a kind of a hybrid. There was a fund that was investing in WTI crude oil as the underlier. And a lot of people who were buying into that, it was an offshore product. All they were trying to do was speculate on the price of oil. And the group that were running that fund seemed not to fully understand the dynamics of physical delivery. So that doesn't normally play into it when institutions are at work, because most of the people who trade the big contracts are familiar with these issues. They don't carry their open positions and expiring futures contracts all the way to expiration, so that they either have to make or take delivery. And even if they do, it often is because it's an offset to other things they're doing. So it's not a big deal. What ended up happening there was that people were just investing in oil as if it was a stock. And then the underlying fund was buying the futures, and they had a huge open interest. I think it was about 150,000 contracts or something like that as expiration approached. Now, 150,000 contracts doesn't sound like a huge number in the financial markets, but as Tony just pointed out, the WTI contract is 1,000 barrels, so that's 150 million barrels of oil that those contracts, if they were carried, you would either have to make or take delivery of during the prescribed delivery month. Now, Cushing, Oklahoma, which is mostly a delivery and point for physical oil trading, only has the capacity to process about 1.5 million barrels per day. And essentially, much of the storage there, because of the grade issue that you were just talking about as well, Tony, if you are required to make or take delivery of a specific grade, you look at all the tanks in Cushing, those tanks are dedicated to different grades of crude that are coming and going from that delivery point. And so even if there was storage available in some of those tanks, it didn't necessarily mean that oil that would satisfy the specifications of the WTI futures contract would satisfy it. So it turns out that there was essentially, with the open interest, an excess amount of crude that had that just been carried all the way to the end, an excess amount of crude that there was no storage, no room at the end, so to speak. And the amount of excess oil was so extreme that if you took DOT regulation crude oil tanker cars, you would have created a train that ran from Cushing, Oklahoma, all the way to Washington, D.C. That's how much excess oil we were talking about. So when you're trading the physical, you're really trading more than just the price of the underlying commodity. You are also trading logistics on that commodity. How much does it cost in some cases to insure it? How much does it cost to ship it? And how much does it cost to store it? And if there is no storage available, the cost of incremental storage can be high. And in that case, there simply wasn't enough storage to take all of the open interest, and people had to unwind their positions. There was just no other way to do it. And they paid dearly.
Yeah, and for all those reasons, for many equity investors, such as the trades that we talk about on Options Action, this is why we use ETFs many times to speculate on the directional view, if you will, on crude. And we use a variety of products for it. I think historically we use USO and OIH probably the most, and XLE occasionally to also speculate on oil, which is obviously the energy producers in terms of energy companies rather than specifically crude contracts. And then there's also USL, which I actually have never traded myself, which is the 12-month contracts or the ETF tied to the 12-month contract. So there's a variety of ETFs that you can trade, but there are different, I would say, issues, meaning they're all proxies. They're not giving you direct exposure to oil for the most part. And there are transaction fees and roll costs embedded into them that some investors are not familiar with, and they range a pretty wide range in terms of pricing. So anywhere from $25 a share to about $218 a share, depending on which product you choose. And for me, I think the most difficult part about these ETFs is really the fact that it's difficult to take a bearish position, meaning buying put options. They're expensive to buy put options. It's hard to bet on oil moving lower with some of these products. And these are some of the challenges that we have on OA in speculating on oil pricing.
Yeah, so an important thing to remember is that if you're dealing with a product like USO, the fund itself has to contend with the underlying dynamics of the futures market. So although a lot of these funds, like the US Oil Fund, like the US Natural Gas Fund, they don't trade the listed futures, the big contracts exclusively anymore. They do a lot of swaps and things like that. One of the things that definitely plays into the behavior of those equity-like products is the behavior of the term structure. Are you in steep contango? Are you in steep backwardation? If you are in steep contango, and what that means for people who are not familiar, is that the price of longer dated futures are higher than the price of nearer dated futures or spot being the current price of the physical commodity in this case. So sometimes that can get quite steep. You might find, for example, that the front month contract is trading 30 and a contract that expires a couple years out could be $10 higher. At basically the depths of that spread last year, I think the spread between the front and second month, because the front was trading negative actually, I think that spread was just shy of $60 or something crazy like that, between the negative contract, which settled at negative $37, I think, on its lows and then going out 6 months or so. And what happens is that if you have a fund and all you do is own the front one or two contracts, as expiration approaches, you have to sell those contracts and you have to buy the subsequent one. Well, if you're always selling something for 30 and buying something for 32, 33, or selling something now, obviously with oil significantly higher, and buying something that's even higher price, you're going to have this decay, this kind of bleed out, because when you buy a share of USO at any given moment, it represents a certain number of barrels. But if you're in steep contango, the following month, all else equal, same amount of capital deployed, you actually own an instrument that carries less, that actually represents less. And so there's sort of a bleed out. The opposite dynamic can exist when you're in steep backwardation. Steep backwardation is a situation when spot and the near dated futures are trading over the long dated ones. And just the shape of those curves alone can tell you a lot about the dynamics of the marketplace. When you have a very steep contango, what that tells you is that in the near term, you have significant oversupply. And if you have oversupply and you have no storage, and that's a case that can exist with physical commodities like oil and gas, that's when you'll see that dynamic. And it makes those ETFs a little bit deceptive. They can't, unlike the futures, they can't trade negative, but they can pay a price associated with the roll cost month after month.
Yeah, that's exactly right. And that is a good segue into the small futures, which I know you recently come across these, and you've come, you and I spoke about this yesterday, and you're quite interested, you were quite vocal about why you feel that these products are very well suited for retail. Could you talk a little bit about kind of your thoughts on this?
Yeah, I mean, obviously the size of the contract is a help. It takes relatively small amounts of capital to trade even the big WTI contracts of 1,000 barrels. You can, I don't know what the initial margin is right now. I could actually look it up. It's probably just shy of $6,000, I think. And with that, you're going to be controlling 1,000 barrels of oil, which is $75,000 worth. So the smaller size is obviously helpful because it means that you can, tailor the size of your positions more precisely than you might otherwise. So that is certainly a benefit, but a much larger benefit from the perspective of almost any investor is that this is a cash settled instrument. And cash settlement is important because it helps eliminate some of the risk that's associated with making or taking delivery of the commodity. Now, look, if you trade those futures, that's fine. Most brokers actually make it very easy or relatively easy. The problem is that if the risk of dealing with the physical, even if it's a small risk, when it does go wrong, it can go wrong so badly. And there's not much reason for it. I mean, is there anybody who's interested, who's on this webinar, that wants to speculate on the price of this commodity or any other, who's doing so with the hope that they're actually going to make or take delivery of the underlying commodity? And the answer is almost certainly not. That's not typically why we do this. I never traded the physical commodity when I was in the futures pits.
Right. So, I mean, these small futures, as Michael said, is suited for retail, and the standardization is really what I think is important here. Is that it trades in 1 cent ticks, and each tick is effectively $1. So if you have a 1 cent move in oil, you're going to expect a $1 move in these contracts. It's 100 multiplier, the equivalent of trading 100 shares of an ETF, and this gives you exposure to U.S. oil. And the expiration dates are also standardized, the second Friday of every single month, as opposed to the third Friday that you're typically used to with options. Second Friday of every single month, the U.S. oil will expire, and they cease trading at 1:30 p.m. Central Time every single second Friday of the month. Just to give you a little background. Now, Mike, I know you have to run in a few minutes, which is why I do want to talk a little bit about oil fundamentals, because this is really where I know your expertise can be very helpful in understanding this. And this is something that it's taken me quite a bit of time to really get a better feel for. So could you talk to me a little bit about the different things that you look at from a fundamental perspective to get a better sense for supply and demand and the things that you look for?
Yeah, so it's interesting. I mean, obviously, it's very helpful, and it was not uncommon in the pits for us to deal a lot with both consumers of and producers of crude oil. So we certainly got some sense of it from that. So I mean, half of the phone lines that would feed into the NYMEX were in Houston. But I think the important thing is that a lot of data that institutions look at is available to everybody. So, for example, the EIA reports, from the Department of Energy, I think this is really the first place I would start. If you're interested in trading oil, go to the EIA website and start reading some of the reports that you have there. It's written in plain English. There are a time series available, so you can get a sense of how much is being produced, how much is being consumed. You can see seasonal patterns there. I think all of those things matter a great deal. And the other thing that I was, of course, always interested in was the open interest, because you can also take a look at, what are institutions betting on. So you can look at basically the positions of traders reports, and that will give you a sense of whether there's more bullish bets or more bearish bets. I sometimes would think that when those things got a bit extreme, when everybody's sitting on one side of the boat, that didn't necessarily mean that you wanted to take a contrarian bet, but I often found that the risk reward relationship became more asymmetric. So if you see that in those positions of traders that they're overwhelmingly bullish, they might be right. But when things go wrong, you often would get these kind of asymmetric price shifts. And that was the kind of thing that I would look for. The other thing I would look for are shoulder months on seasonal effects, right? So We're talking about oil right now, but you want to take a look and see, are refineries open or not? Sometimes when you have a lot of refineries offline, that can curb demand a little bit, and then you can see a big demand spike when everything comes back. Obviously, going into driving months like the summer, gasoline demand will increase. A lot of these things are fairly obvious, but going to the EIA website is going to help you a lot, because it's going to throw numbers, to these concepts, and you can sort of track that. And I think that's going to be very interesting. And I actually would really encourage people to take a look at it, because, the supply demand imbalance that we saw last year in 2020 was the most extreme in my professional career by a long shot in the oil markets anyway. But that's the first place I would look. And on the open interest side, the reason that's important is for exactly what we're talking about there too, which is that if you have a lot of folks carrying open interest, they might, that's, especially as expiration approaches, there might be a little bit of a hold on and hope that those people are experiencing, but they have to unwind it if they're in the physical futures, and that can also play into the price. Now, these small futures are actually going to be expiring prior to that, so some of those really wild dynamics that can happen around that, are less likely, I think, going to affect these.
Right. So I just posted a link to the EIA website for everyone who's interested in finding that link into the chat window. So let's just talk a little bit about these EIA reports, right? You have everything from output to inventories to imports in that report. And, in the current market that we're in, I think everyone is fairly, fair amount of consensus that, the second half of this year, there's going to be a fairly strong amount of demand, if you will, from the reopening, from airline to get to, driving everywhere, because again, and the EIA reports gives us a better sense for also the supply side, right? Because right now we're seeing inventories are falling. Production is fairly steady at this moment. So the question is really, is there a supply for the increase in demand that we're expecting in the second half? And I would argue that the price action that we've seen here over the past couple of months has really reflected this, what I think is not a supply for increasing demand.
Yeah, I'm not sure if it's my internet connection, Tony, or yours, because you're breaking up just a little bit, and hopefully people can hear me as I respond to that. We're definitely seeing demand come back with a vengeance. And obviously oil is just one of the places where we're seeing it. And we often think about things like oil production as if you just turn the spigot on. It's like, going to your kitchen sink and flipping the lever up and oil comes online. It isn't quite as simple as all that. So one of the things I will often say about commodity prices is that whichever direction they're swinging in, they often will swing a little bit further than you think they will for that reason. So there tends to be what some people who are less experienced looking at these markets would think of as an overshoot, but it just isn't that easy logistically to turn things on and off as quickly as people might expect. Demand is definitely there. And then of course we have something else going on, which is not simply whether we have adequate supply in the event that every producer is maxing out their output, because that's part of it. The other issue is whether or not they want to maximize their output. And what we're seeing out of OPEC right now is that they're trying to take advantage of this dynamic and stabilize prices at a relatively high level. What a lot of people don't realize is when prices fall very far, they expect the oil producers to basically curb their production, get the prices up. But the problem is the price falls when you have a lot of states that depend heavily on oil revenues. Even if they agree to basically set a level of production or even curb production slightly, there's oftentimes a little bit of cheating that goes on, because as the price has fallen, their revenues have fallen. And there's a temptation when you have the capacity to increase your output and your revenues are not where you need them to be, to maybe sell a little extra. So this is another reason why sometimes when the pendulum swings, it tends to swing a little bit farther than you would think to the downside and a little bit farther than you would think to the upside. I think right now, the Delta variant, other things going on the coronavirus front. I don't know whether people have the patience to see the kinds of shutdowns we've seen in the past. But right now, I think the fundamentals for oil and energy are very strong.
Yeah, that was really the only thing that I was saying, is that, that's really the only downside risk that I currently see with oil, especially to the demand side, is really potentially more stricter lockdowns that take a dent in terms of demand. But I think this leads me to my last question for you, which is on OPEC. Do you see OPEC as largely the controller, if you will, of oil prices, as many people call OPEC the cartel? Do you see OPEC as the overarching control of oil, or do you think market forces are still behind, the changes of oil prices going forward?
So, obviously what happened in North America with production here as a result of fracking, obviously the finds in the Permian Basin, OPEC was basically driving the bus for a very long time. The United States actually became the largest oil producer for a period recently as a result of the fracking boom. Our production was enormous. We were producing, more than half of our consumption. I think we were doing a little over 12 million barrels a day on 20 million a day of demand. And, that changed the dynamic. Fracking totally changed the game. Before that, OPEC was strongly in control. Now, it's important to remember that I'm not trying to dismiss their ability to influence global oil prices. They obviously still have a significant influence over oil prices if they elect to try to do it. But it isn't as strong as it was. So I think that's the first thing. The second thing was that, we have more reserve capacity to meet unmet demand here than some other places do. We often think about Saudi Arabia, which is generally speaking the largest producer under more normal conditions, excluding the fracking. But the truth is, I think that they have for a long time run at pretty close to capacity. So, I think what's going to happen is if we see elevated oil prices for a time, more capital flows into it, begin to see some ramping on the production side. And they still have an influence. Of course, the long-term dynamic is a little bit different, which is that, it's principally a transportation fuel. And, we're going to see over the next decade a huge migration from ICE vehicles, internal combustion vehicles, to electric, and that's going to have an impact on transportation fuel demand, a fairly significant one, I would think. And then, of course, we've got air. Air travel, of course, is starting to pick up significantly, and that obviously has a big play on the demand for jet.
Right. So I completely agree. And that's really kind of one of the things that we spend a lot of time on OptionsPlay, is understanding that shift from, fossil fuel over to renewable energy, and kind of when that, I would say, the tide will change, if you will, on that front. Because at the moment, there's clearly is still strong demand for fossil fuels. And is driving oil prices higher. Energy, one of the strongest sectors of 2020, is still fairly strong here in 2021. As to how long that trade can last for, and that really is kind of partially where I turn to some of the technicals, especially the longer term technicals. Especially if you look at the weekly chart, one of the things that we notice is that the oil's approaching this $75 resistance level, which has been put in the 2018, early 2019, that we're just approaching here again as a double top. We could very well bounce off of this level, but a breakout above the $75 level would really put us back towards 90, even as high as 110 here to the upside fairly quickly if we get back above that $75 level. On the daily chart, things do look a little overbought. We talked about this last week here on Options Action, as we see a little bit of exhaustion on this last move from 58 or so all the way to 75. And today's price action off of the OPEC meeting. You know, this morning we got back above 75, but very quickly came back below 75. Price action telling us a little bit that, you know, perhaps this is a little, we're seeing a little bit of exhaustion here on oil. So from my perspective, things look on the daily chart looking like they're a bit of exhausted, but longer term, if we do break out above that $75 on that longer term chart, we are headed, in my opinion, significantly higher here.
Yeah, I mean, I think
Michael, I know that you are on. Sorry,
yeah,
go ahead.
No, it's true. I do. I'm, you know, for those, I don't know if people are able to see me. If you're looking, maybe you can see in the background. I'm at the NASDAQ market site in New York City's Times Square, 43rd and Broadway. This is where we do the fast money and options action shows from, or where we did in more normal times. And here we are, coming fast to the 5 o'clock hour. And so I don't know if you can see in the background there, that person is Melissa Lee. But yeah, we're going to be getting going with the show pretty soon. So unfortunately, I'm going to have to drop.
Well, Michael, thank you so much for your time today and your expertise on oil. I'm really glad that we got a chance to talk to you a little bit about these oil fundamentals, supply and demand. So I'll let you go. Enjoy fast money, and I'll see you on Options Action
Look
tomorrow.
forward to it. Enjoy your travels. Thanks, everybody.
Thank you so much, Michael. So with that, let's jump back over to Tastyworks and let's take a look at oil futures, or these small oil futures here for trading the products that we just talked about. So the small oil futures, which you can find on, for example, Tastyworks, and there's a list of brokers that I'll share with you here in a second that you can trade these futures with. The oil futures were listed fairly recently, and they give you exposure to US oil. And this is a 30-minute chart that I have, and this is the price action I was referring to. We had the breakout here above $75 intraday, and it came back down to below that $75 level. And so far, it is starting to retest this $75 level. Found a little bit of support around 74.70 or so, perhaps looking for that continuation higher. But we did manage to break out above what has been a multi-day resistance level around 74.15 or so. So today we had that breakout. We're coming back to retest this level near support level, and perhaps we're seeing a bounce higher here. But, you know, like I said, if you, depending on whether you're a short-term active trader, right now, certainly looking like we're about to break out. But on a longer-term chart, if you look at that daily chart, there does show a little bit of exhaustion as today's breakout above $75 so far has failed. For me, if you're a longer term trader, I think there could be some downside here for oil, but watch that $75 level here to the long side, because if you do have that breakout above 75 and it sustains that level for a couple of days, that's really when you look at the long-term chart, I do think that there is opportunities to go all the way back up to 90, even as high as 110, especially on these supply and demand dynamics that we refer to. So let me just walk investors through this trade here for 1 second here. So the US oil is currently trading at 74.95. So this is the equivalent of buying an ETF that's currently priced around $74.97. And each contract that you purchase of US oil is effectively the equivalent of buying 100 shares of this ETF. So when you buy 100 shares of an ETF, for every 1 penny that the ETF moves by, you are going to see a $1 increment in terms of profit and loss. And that's exactly how these small futures are structured. They're easy to understand. So for every penny oil goes up by, you're looking at $1. For every dollar that oil moves up by, you're looking at $100 in P&L. Now, the difference here with the small futures is the fact that when you buy 100 shares of an ETF, you have to either post the cash, which is 100% of the purchase, or 50% of the purchase if you're trading on margin. But for example, when I trade an oil future here, my buying power here is only reduced by $1,100. So this is what is going to allow you to control about a $7,500 contract for about $1,100. This is the margin requirement that you currently have for these oil futures. So they're fairly capital efficient. You do not need to have $7,500 in your portfolio or half of that, $3,500 in your portfolio in order to trade these contracts. But I will say some of the things that we talked about here in the past few weeks as we talked about small futures is that because you have the capital efficiency, that means that you have access to leverage. Now you need to be very careful when you're accessing leverage because it is a double-edged sword. It will work in your favor if you trade and the trade and oil moves higher as you buy this oil, but if it moves against you, you have exposure of a $7,500 contract, even though it only costs you $1,100 to purchase. So the exposure that you have is the full contract, but it simply requires less capital for you to hold onto the contract or get into the contract. So this is how you can access the oil futures here using the Tastyworks account. And what I'll do here is I will share with you here a sense for these small oil futures here on Tastyworks, which you can access through the watch list. Under futures, there's a specific section for small exchange futures that will give you a list of all available small exchange futures that you can trade. As you can see, SMO is currently trading at about 74.93 by 74.97. When I click on the ask price, that will allow me to go long US oil. But one of the great things about futures contracts, unlike ETFs or options, is that you can easily short a contract as easily as you go long a contract. So if you're shorting an ETF, there are a lot of other things that you need. You need to make sure you have a margin account and you need to be able to borrow that. And on top of the fact that you have unlimited risk. When you trade a short future, you still have that unlimited risk factor, but you can easily go short this market, a futures contract, rather than having to borrow an ETF in order to short an ETF. So it's a little easier to short, and that's really what makes it easy for day traders to be able to take directional views in both directions just as easily as it is to take a long position using small futures or futures contracts in general. So regardless of whether you're bullish and you're looking to buy that contract or bearish, looking to sell that contract, you can do that with the click of a mouse by either clicking on the bid or the ask price, and you can simply place your orders. I have found that I'm able to go off usually at the midpoint or no more than a penny off the midpoint in order to send these orders. And as you can see, the buying power effect here is $1,100 on a effectively what is a $7,500 contract. And for those that are familiar with trading these types of contracts, there's a variety of contracts that you can trade, and I'll show you some videos or links to videos if you want to learn more about some of the other ones. We've covered interest rate futures, we've covered the precious metals futures, we've covered the US dollar futures, but for access to a contract that is accessible to all investors, even for retail traders, is really the ethos of small futures, of small, simple, and standard and simple for these futures contracts. And recently they just launched the 420, which is the cannabis future. For those of you that are interested in trading the cannabis futures, another way to access a basket of cannabis companies through some of the ETFs that are available. Just to, again, a more capital efficient to access exposure to the major cannabis companies here in America. So with that covered what I wanted to share with you here in terms of giving you a better understanding of just future complex, if you will. I do know that, even for myself, when I started trading oil futures, it was a minefield just to understand what I'm actually getting exposure to. Many times some people are concerned about the fact that, when they're trading oil, they're not exactly sure what contracts they're getting access to. This is way that you can access US oil in a very easy to understand contract, and be able to get a better understanding as to what are the fundamental factors that underline, the directional view of oil. Because a lot of investors find that it's difficult to understand as to whether they think oil is going to go higher or lower EIA reports, I highly recommend investors to take a look at it, because it's structured in a way that I think is very useful even for someone who's new to trading options. I'm sorry, new to trading oil, because sometimes when you look at the oil futures, you look at complexity around, as Michael was saying, the fact that you have different delivery points, nat gas. What are the differences between all of these? The EIA report actually makes, I think, plain in English for a lot of investors. It gives you a good sense for, our oil producers, our refineries increasing production? Are they decreasing production? Actually explain to you that the current production is at this level. It's reduced by X amount over weeks. It'll also show you whether inventory levels are higher than lower than average, so that you can get a sense for that. So all the things that we talked about here during today's session, where as oil inventories and production remain steady, yet demand is actually increasing. These are all basic things that most of you can understand, and is available for free to everyone using the EIA.gov website that I just posted into your chat window. And then, you always are free to get technicals, which I think is always a strong indicator, if you will, of time, especially for those of you that like to use charts. I think the technical charts give you a sense for that's likely going to, especially a breakout, as we've seen here right now. I think that we're just testing that 75 level. We have not seen the breakout yet, but that's really one that I would pay attention to. As we break out above 75, that's where I think you see that and I want to answer questions this, because for the on options, you can variety of products that we have used to get exposure to oil, whether it's USO, OIH, XO. I think someone before said XOP, and we've used XOP before, and also XLE. But none of these are really giving us true exposure to oil. These are all proxies to oil. And it's the best that we can do when we're trading equity options. We can't trade these futures on options action. But for those of you that are here during this webinar, you can trade these small futures. And that's really where, hopefully today's session gives you an understanding of some different products that are available to you that may give you better exposure, or direct exposure rather, to oil in both directions, whether you believe options oil is heading higher or heading lower. The small futures contracts really allow you to do that. So what I'll do is I'll leave you with just a little bit of a better understanding of oil futures, and I'm going to cover a couple of questions that I know a lot of investors are frequently asked questions about small futures. I want to cover these first, and then I'm going to open this up for Q&A. So the first question I want to answer is really around expiration. So there's quite a bit of question, with all the small futures, the standardization is key, the third Friday of every single month. The exception to that is the small oil futures. And this settles on the second Friday of every month at 1:30, and the last trade is at 1:30 p.m. Central Time. So 2:30 p.m. Eastern, second Friday of every single month is when the small oil futures expire. And they are all cash settled, which means that if you hold one of these contracts to expiration and you don't close it out and you don't roll it to the next month, the profits and losses that you have on the open contract are simply settled in cash into your account. So you never have to worry about some of the things that Mike was referring to in terms of risks of taking delivery or having to deliver physical oil. As far as which brokerage firms you can trade small futures, there are a variety of brokerage firms that you can trade these small futures, but the two major ones that you might currently have an account with, or you can trade equity options with, are Interactive Brokers and the Tastyworks account. So Tastyworks and Interactive Brokers are the two major US brokerage firms that allow you to trade equities as well as these small futures contracts. And I just want to address one question that I have received quite a bit of over the past few months as we've introduced these small oil futures, is the fact that many investors say have commented that there are many times just a few hundred contracts traded a day in some of these products, and some investors have been concerned about liquidity. And the one thing I will say is that volume and liquidity, while many times are correlated, but low volume is usually a reflection of the fact that a product is new and it's just listed. And that really does not necessarily mean that it's not liquid. So I have traded pretty much all of these small oil futures products. I can tell you that despite what might look like sometimes a spread that looks fairly wide, many times most of these spreads are just a few cents wide. But even ones that are 4 or 5 cents wide, I've been able to get filled on these trades by moving these trades usually 1 penny off the midpoint. So the same practice that we have as options traders to use the midpoint as our gauge for placing an order, you don't necessarily have to also look at the bid-ask spread and assume that you have to pay that spread. I have found liquidity by being able to enter these trades at the midpoint, usually 1 penny off the midpoint, in order to find liquidity. So while you might see wider spreads quoted on the screen, many times you will see executions within the spread. Just like when you trade options, you don't pay the bid-ask spread. You always place your orders at the midpoint, usually a couple of pennies off the midpoint. But when you're trading futures here, I always start at the midpoint, move usually 1 penny off of that midpoint if I'm not getting filled immediately. And that's where I have been able to find liquidity for these types of products. So with that, that covers the primary frequently asked questions that I usually get with these types of products. So with this, at this point, what I'll do is I'll open this up for Q&A. There is both a chat window and a Q&A window. For those of you that have some questions, you can type them into the Q&A section, and I'll try to answer as many questions as I have time for here today. Okay, let's see. I've always been intimidated by trading oil because I feel that geopolitically manipulated. Can you comment on that? So Joseph, that was one of the questions that I asked Mike, right? Is to what his view is on the fact that, is oil effectively manipulated by OPEC in terms of as an oil cartel, if you will? And you heard his answer regarding the fact that prior to U.S. fracking, that was the case. The OPEC nations controlled the vast majority of production. U.S. fracking has changed that. There's no doubt that OPEC still has a fairly strong influence. As you saw today, the OPEC meeting has caused a bit of volatility here in the markets, but they have slightly, I would say that they have less influence these days than before U.S. fracking started. What indicators do you use on your charts? So I use a simple set of indicators. I use a 20 and 200-day moving average, and I have an RSI, and I have a money flow. RSI helps me measure momentum, money flow helps me measure breadth, and 2 moving averages help me understand trend and major support and resistance levels. But that's largely it. I'm not a big fan of using a ton of indicators on my charts. I tend to find that the more indicators you have, the more confused you might end up getting on the chart. Can you take us through an actual trade of Tasty on real oil? So I think I just did that, Harley, just to show you on Tasty Trade, how to look at the oil contract and whether you're bullish or bearish, how to either buy the futures contract or sell the futures contract to take a bullish or bearish view on oil. How do you decide when to use a credit or debit spread? So that is a different topic than what we're discussing here today, Daniel. If you, but I'll answer that very quickly. Whether you use a credit or debit spread is contingent on directional view. The stronger the directional view you have, the more you lean towards a debit spread. The less or more mild views that you have, you lean more towards a credit spread. Great question here. Do small oil futures have day trading events? That is one of the main benefits, in my opinion, of trading a small account and trading futures, is that there's no pattern day trading rule when you're trading small futures. You only have a pattern day trading rule when you're trading equities. how many contracts do you enter on average? So Barry, this is really where that depends on your account size. You want to make sure that you size this appropriately. Remember, each contract gives you about 7,500 worth of exposure. So you want to size it appropriate based on that amount, right? So if you have a relatively small amount, you probably only want to trade one, maybe two contracts. If you have a significantly larger account that is in the hundreds of $1,000s or millions of dollars, that's really where you can trade contracts. But remember, each contract is $7,500, and that's how you want to size your trades. Gabby, I resent a link to the on the chat window so that you can see. Could you demonstrate risk to reward if you buy one futures contract? So that's really the easy thing about understanding these futures contracts, right? Unlike an option where risk and reward is asymmetrical, when you're trading in a futures contract, it's like buying 100 shares of an ETF. Your risk to reward is completely symmetrical. If oil goes up by $1, you make $100. If oil goes down by $1, you lose $100. So it's really easy to understand your potential risk and potential reward because, again, it's much more similar to trading 100 shares of an ETF than to trade an option where you have less visibility, or it's harder to understand exactly what your potential risks and rewards are. What time on your chart do you look at when you're trading futures? So that is very dependent on how actively you want to trade. As an active trader, you might want to use anywhere from 5-minute to 30-minute charts. This chart I have on my screen is a 30-minute chart. If you're a long-term investor, that's really you want to look at daily charts or perhaps even weekly charts. But that's solely dependent on how actively you like to trade. Again, active traders will use intraday charts. Long-term investors will use typically daily and weekly charts. What are the data points to keep an eye out that could affect the contracts in a major way? So, if you're looking at point Y, where the EIA reports that come out every single week, that's what you want to keep an eye out for. That I sent you a link into the chat window, but also some, if there's an OPEC meeting, such as the one that's happening right now, those are the things that really can influence short-term volatility and price action. As we saw here today, the OPEC meeting is part of what has driven oil significantly higher at open and is now pulling back here. So OPEC meetings and those EIA reports are primarily the type of fundamental factors that will cause some short-term volatility. How many days to expiration do you open the contract and when do you close it? So Aris, this is not like options. You can these contracts are monthly contracts, so you basically open them. Usually want to roll them out about 3 days before the expiration date if you want to maintain exposure in the underlying. But the 45-day and 21-day rule, that is only for options. This does not apply to futures. Futures, you basically hold a contract until about 3 days before expiration. That's when you want to roll them to the next monthly contract. Tom, hi Tony, this is one of the best videos you have made. Could you make a part 2 to go more in depth using options on oil futures? So Tom, I know the small exchange is working very hard on introducing options on these futures contracts, but right now those are not available. They are coming down the line, but at the moment there are no options on these oil contracts. You can only trade options on USO, OIH, XOP. These are the ETFs that Mike and I talk about on Options Action. So those are the only products you currently have access to as a retail trader, in my opinion, for trading options on oil contracts. But once the small exchange offers options on futures, that's when we anticipate that we will also be doing more education on that as well. Where can we find the tick size for the contract? So that's the one great thing about small futures is that all small futures are standardized from this perspective. Every single tick is $1. Unlike regular traditional futures where tick sizes are different depending on the products that you're trading, all small futures contracts are $1 per tick. It's just, like I said, it's the equivalent of buying 100 shares of an ETF, so that every 1 cent move in the underlying equates to a $1 P&L for your portfolio. Every single small contract, oil, interest rates, US dollar, the small 75, the technology index, the marijuana index, these are all $1 per tick. So that's the standardization that the small exchanges brought to futures that I think is so interesting for especially for those of you that are options traders. You're used to 100 shares per contract, so that's exactly what each small futures contract represents. And each tick is going to be $1. So everything is standardized no matter what products you trade, both as a directional play and as a hedge with small oil futures. Tom, I'm not sure I understand what your question is there. If you don't mind clarifying, I'm happy to answer that. Is there a different margin requirement if not traded during daily trading hours? Yes, different amounts. The margin requirement is $1,100 a contract right now for the 7,500, with oil trading at 7,500 right now. That will change if volatility changes, but as of right now, your margin requirement is $1,100 for the contract. I apologize if some of you are having some, if I'm having some audio issues here. But the value of an oil contract is, the price of oil, which is right now about $75, multiplied by a 100. So each one of these is a 100 multiplier, just like an option contract of 100 multiplier. So when you have a $75 product, a 100 multiplier implies a $7,500 contract. Do you strictly day trade or do you hold your positions over several days or weeks? So Tom, I was a day trader on options. In futures many years ago. But I run the OptionsPlay as my primary business now, so I trade these futures as a longer term view. So I am no longer day trading any futures contracts. I've taken exposure in interest rates. I've taken exposure in US dollar in a longer term view using these types of products. And the interest rate product is a very innovative product because it's the only product that allows you to trade the interest rate itself, not the inverse, which is traditionally the bond futures that you have to trade or a bond ETF. This allows me to speculate, if you will, on my longer term view on interest rates using these futures. You can do it on gold, you can do it on oil. Most of the commodities that we talk about, on a day-to-day perspective, these futures contracts provide you direct exposure or a direct exposure, if you will, to these commodities that many times as equity traders, we have to find an ETF that's a proxy for it. Like for example, GLD when you're talking about gold, or USO if you're talking about oil, or UUP if you're talking about dollar. But these small futures actually give you direct exposure now to these commodities or indices that we talk about quite a bit. Why trade oil futures instead of USO or XLE? Great question. First of all, XLE is not an oil ETF. It is exposure to oil companies. That's two very different dynamics because oil companies are, while correlated to oil, is not a 100% correlation. For example, crude is up about 20% over the past month. XLE is only up about 11% during that time. So you're not getting dollar for dollar exposure. USO gives you close to exposure to US oil, but USO has roll costs embedded into them. So if any one of you have bought USO and you look at how much USO moves up by versus how much crude has moved up by, that also is not a 1-to-1 ratio. So small futures give you direct exposure to oil versus the other vehicles is effectively a proxy. When you pick the current month contract or the next month or the one after, so Aris, you always want to trade the front month until about 3 to 5 days from expiration. That's when you want to roll it to the next month. Whenever we trade futures, we usually like to roll about 3 to 5 days before the expiration date is up. Your margin requirement can change. But that usually will only happen if, let's say, the volatility of oil was to change substantially. The margining for futures is a factor of the volatility of the underlying product. So, Michael, perhaps this is one that Michael is, can shed a little light on here. But margin requirements on oil do not change very often, but when they do change, it's usually because of a change in the volatility of the underlying instrument. What is the small exchange? The small exchange is a new futures exchange, and every single product that the small exchange offers follows the ethos of small, standard, and small, simple, and standard. So small, meaning every single contract is sized specifically for retail with a smaller account. Standard, meaning everything is standardized. So like I said, every tick is always going to be $1. Unlike for those of you that ever looked at other futures contracts, you know that tick sizes are all over the place depending on which product you trade. Expiration dates are all over the place depending on which product you trade. The small exchange has standardized all of that to the third Friday, just like your options products. And I simply think that there are simple products to understand, oil, gold, US dollar, interest rates, direct exposure to the things that we all talk about, but many times struggle to find products that actually give us exposure to those things. So those are the reasons, I think it's worth looking into the small exchange. With that covers, the questions here for today. I just want to thank investors for taking the time out here today. I hope that this gives you a little bit more clarity into what oil actually is when we talk about oil, how you can get exposure to it, what you're actually getting exposure to it, as well as providing a little color into how you can understand the fundamentals and technical picture of what is a complicated commodity. With that, thank you so much. I hope you guys have a great trading day. We have this session recorded, so I will send you the recording after we finish here today. So hopefully you'll be able to have some time to review the recording along with the slides for today. Thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.